Hello, and welcome back to our new podcast series, Lending Unbundled, sponsored by the good folks at TruStage. Today's episode, episode 3, is about decision governance, which I'll admit doesn't sound like the sexiest topic in the world, but it's important. In an increasingly modular and efficiency obsessed lending ecosystem, in which numerous different parties touch different parts of the loan and different stages of the lending lifecycle, how do you ensure that the decisions that everyone cares about, the decisions that ultimately impact the performance of the loan and the financial outcomes for the borrower, are being made correctly? In a vertically integrated lending ecosystem like we used to have, that was easy. The same party that acquired the borrower was the same party that made the underwriting decision and the same party that funded and serviced the loan. In our current unbundled lending ecosystem, it is much more difficult, but it's not impossible. As our guest today, Aditya Kandekar, Chief Revenue Officer at Corridor Platforms, explains to my co-host Bjorn and I, lenders are increasingly investing in systems and processes to create stronger decision governance across the lending lifecycle. Now, they're doing this because the lending ecosystem has become much more complex and much more fractured, and it is, to be candid, the only rational response to that complexity. As you'll hear, Aditya is a great podcast guest. Bjorn and I have both known him for a long time, and he has a real knack for using specific stories and examples to illustrate his broader points, which on a topic like decision governance is really essential. I'm excited for you to listen to our chat, so let's get right into episode 3 in our series, Lending Unbundled. Aditya, thank you so much for joining us.
Thank you. Thank you for having me. Appreciate it.
It is great to see you again. I know you and I and Bjorn have all sort of known each other separately, so I'm glad we could bring this group together for a fun conversation. The focus of our series, as you know, is on sort of how we as an industry can and should adapt to the changing kind of lending ecosystem as it's become more modular, more fragmented, more complex. And we're very keen to get your perspective on that as someone who's worked more on the risk and analytics and governance side. But before we get into that, I would love it for folks who are listening, if you could give a little bit of context on your background, on Corridor, and sort of like what decisioning governance means so that we have a good framework for our discussion.
25 years of experience. Interestingly, I started off as a computer engineer and then kind of made my way into finance and then deep into data analytics and approached it from marketing and fraud side. So credit risk was kind of the third innings in my analytical learning journey, primarily in regulated verticals. So it did give me, interestingly, the flavor of, when you look at financial services, healthcare, insurance, kind of did work in all the three domains. And interestingly, well, based on the spine of this podcast, it was all about governance, right? That was a commonality of thread. How would you do underwriting for an insurance policy as an insurer versus how would you do customer or member management as a regulated decision in financial services? Governance was the underlying thread, governance and compliance, and the ability to do continuous governance and compliance. And I will get into that. So that was a thread. And as I think about governance and compliance, how it's evolved, one has become more dynamic. It's moved from being, governance was always thought about, well, I'm going to have an external validator come and look at the model, do the model governance, run my fair lending compliance, do my model performance, my AUC, my KS statistics and such, and then submit a static report and then don't do anything for the next 6 months. But that is not anymore. It's becoming a continuous piece where not just from an external regulatory standpoint, but also from an internal monitoring perspective, you have to run governance of your decisions. And believe it or not, governance tied to business outcomes, not just as a second line CRO risk function, but even as a first line. So look at decision automation, decision approval, auto declines, your loss rates. How is that progressing? Are you, from a fair lending perspective, how is that How's that progressing for your decision outcomes? And also, once you get a funded loan through the door, how do you do delinquency management or pre-delinquency and then post-delinquency management? How do you do that with governance? So think of governance becoming more of a full life cycle rather than at a point in time statically, or only at the point of acquisition and you fire and forget. So that's the dynamic that is changing over time. Yeah. Yeah.
Yeah, no, that makes sense. And it's a good lead in actually to what we wanted to talk about, which is sort of how all of this has evolved over time. I mean, one of the things that we've been talking about in this series is the impact of a more kind of modular lending ecosystem on a lot of these processes, right? And it's funny, but I would sort of think, and correct me if I'm getting this wrong, that 20, 25 years ago, a lot of governance, it feels like, was kind of built on the assumption that all of this was going to be sort of vertically integrated, right? So you kind of could do that like fire and forget process because it was all happening inside one set of four walls, right? The decision wasn't going outside those walls. The loan wasn't getting passed over to someone else. Like, it was very sort of self-contained. And as such, like, governance was an important step, but it was like one step. It wasn't this continuous sort of thing that you're describing. Help us kind of connect what you've seen from an evolution on the governance side to how you've seen like the ecosystem evolve and become more modular and in some ways kind of more fractured.
Starting to see, and you actually cover quite a lot of that in your Fintech Takes newsletters and thought leadership articles and podcast, which is institutions, and we actually see that on the front line. There are still a set of institutions that are fully vertically integrated. I think that's a great word to use. So they do the entire thing from pre-approvals to originations to delinquency management, and then upsell, the growth and upsell, all of those aspects kind of in one cohort as part of their overall value proposition. And I think the larger banks still will continue to do that. So the tier ones and tier 1.5s are in that area. But when you start to look at institutions in the mid market, I feel, and then you got specialty lenders, and you got that ecosystem. But leaving that aside, even in the core FI space, when you look at the mid market, you're starting to see folks chop it up. So you've got the originators, and they could be front run by fintechs, but then you got the originators. It could be the institution itself. I will work a lot with credit unions without naming them. A couple of them that I'm currently talking to deeply have this mindset of participating loans. So you've got the originators who will bring in, have the underwriting standards and acquire the loan, and then be ready to either wholesale put it into a participation network, or if they are sophisticated, think about tranching them and kind of generating liquidity. And then, in a sense, what's going on here is, and I think it's a function of time or the times we are in, when there is more risk of uncertainty of the cash flow that is tied. So it could be the inflation, it could be the credit risk of the underlying borrower. Institutions, based on where they are, might say, well, let me take out the uncertainty by capturing that present value of it today by acquiring the loan and then tranching it and putting it in the market. So then there's more velocity of transaction, and they're essentially doing balance sheet management from that perspective and capturing the net profitability or NPV upfront, and then somebody else takes. So I think that dynamic of the uncertainty in the credit markets is creating risk and return appetite on the spectrum of risk and return, where institutions where they want to be, and being fully integrated vertically is maybe not the best option, right? So you have originators who would acquire the loans meeting certain criteria, transfer it and move on. Then you got servicers who could be the originators, or it could be the final funder where the loan is going to be sitting on the balance sheet, who are doing the servicing. But their incentive model could be they earn a fee per servicing every month that they're servicing a loan, not necessarily tied to delinquency management, right? And so, their job is to do a certain set of things and do their best effort and earn a flat fee. So they're not incentivized to collect every dollar, potentially. And then you've got the sense, not necessarily the issuer, but the funder, where the loan finally sits in the balance sheet, where then they're handling the relationship. And then, to your point, when something goes bad, then everybody's kind of finger pointing, so, where does this sit? Who's responsible for this? And that orchestration might not be working very well. And you've brought out in your series, where there've been some certain blow ups recently and such. So I think that's the market we're living in, and that's driven off the market dynamics. Now, governance can be a connective tissue across all of this, right? So if you have a governance layer, it's almost like a shared evidence layer that connects all of these together. Even if we are separate firms with our, Chinese walls in between, but I'm able to pass information to you in a structured way in the continuous decision journey that enables you to make better decisions, or together we bring better credit, or we service credit in a better way. That orchestration layer can be through the governance. Let me give you an example. So I don't want to speak in abstraction. Let's take an example. Let's say that eventually the loan has come. I'm going to use Beyond as a guinea pig here. So it's Beyond's I issued a loan to Beyond, and I'm the final the funder that is sitting here. Now I am watching. Beyond did not interact with me; he interacted with the fintech when the loan was issued. But now it's sitting with me as a FI, let's say a $30 billion FI. I am watching as part of my performance package. I'm monitoring that loan fully, right? And we are seeing this, so this is not hypothetical. We're seeing that. So I have my vintage curves. I'm also doing my bivariates on those. I'm looking at them by the FICO bands. I'm looking at loan to value, DTIs. I'm looking at off us, on us. I'm running my compliance dashboards, my compliance and governance, and I know exactly where Beyond is. When I start to see certain patterns of credit stress, I want to be able to take the shared evidence, go back to the issuer and say, hey, this is what I'm observing. I want you to sharpen your underwriting standards. And remember, this sharpening is not going to be one blunt hammer. It's literally like a surgeon with a scalpel. You're going and, you're taking out the cancer cells and you're kind of making sure the rest of the stuff is okay. So you have to have that feedback loop that is coming in. It has to be done through a shared evidence or a governance layer, where somebody's running the governance. The originator is not responsible for this, but the originator is contractually obligated to listen to the changing behavior and adjust their strategies. So then I'll continue to, essentially offload those loans in the future. So that there is that whole commercial angle or a contractual angle that's also tied. So that's how you close the loop from that perspective. So those are my thoughts.
Yeah, that's a great example, and I want to sort of dig into that a little bit more, because as you describe, like that is kind of the idealized way that a more complex ecosystem with multiple parties can work, right? Which is to say that, we all have our piece that we specialize in. I acquire customers, I do the underwriting, you do the servicing, you over here take the loans and hold them on your books. Like everyone kind of plays a different role. But what's interesting, based on what you described, is there's sort of like the mechanical contractual things that you're required to do. And then there's the like more idealized, this is how it should work, right? Because obviously, like if I'm originating loans and then selling them, I want the parties I'm selling to, I want to have a good relationship with them. Like I want to cultivate trust with them. I want them to be able to come back to me with feedback on, hey, we want you to sharpen this up. We want you to adjust this. And over time, the strength of that relationship becomes a competitive advantage for me because I have these trusted funding sources and things I can rely on. Bjorn, obviously in this hypothetical, you'd be a great borrower who'd never have any problems. But I do think that one of the things that I notice that we can use TruStage and payment protection insurance as an example of this is I when I first sort of learned about payment protection insurance in a modern context, I didn't think about it at all as a mechanism to enable better relationships essentially between originators and investors who buy loans, right? But like that's another example of building more sort of trust and comfort, because especially when you're starting off and you're an originator who doesn't have much of a track record working with secondary market investors, you need some of these mechanisms we're describing to like create and foster that trust and that relationship. And I think that's something at least I haven't thought a ton about as a part of this like modular fractured ecosystem is what ends up happening is a whole bunch of different parties have to get to know each other and trust each other. And that's hard to do without some of these mechanisms. So from your perspective, how do you look at that?
I agree with you. I think we talked a lot about the modularity that we see right now with a lot of new players, a lot of legacy players, everyone coming in. And you're right, especially when you're a young startup, trying to build trust is extremely difficult. So figuring out ways on how you can, I don't know, maybe find a catalyst that supercharges the trust building is key. And insurance can help. Payment protection. There are debt protection products. There's tons of different things out there that I think can ultimately help both the consumer as well as the financial institution, or in that value chain, trust in handover, whatever it is. And I think the insurances, it's just one thing that can be done. Mm-hmm. There are many more, but you are right.
Well, and Aditya, maybe going back to something that you mentioned before about like tying governance to outcomes, to business outcomes, I want to press on that one a little bit more too, because it does feel like, and you mentioned this in an earlier answer, like everyone has slightly different incentives, right? And the more like modular the system is and the more different specialized providers you have sort of plugged into that ecosystem, the more there is room for like slightly different incentives to sort of creep in. And I'll give the example of one of my favorite sort of fintech infrastructure examples is like embedded second look financing, right? Where you have companies that sit behind lenders kind of invisibly. And if the lender can't approve the borrower for a loan, they can kind of automatically get screened by a second look provider using their own credit risk policy or underwriting. And maybe they get approved. And what's fascinating about it is it really divides up the roles, because the company acquiring the customer still acquires them, but they might not be the ones who approve them. And then if they're approved, that then might get sold to a different investor on the back end that works with that infrastructure provider, but the loan still might be being serviced by the original company that acquired the customer. And, it gets into these very interesting sort of tensions where it's like, from the company's perspective, if we were going to say no to this customer and we were working with the second look provider and they approved the customer and then sold the loan to one of their investors, like if I'm servicing it, I probably have contractual requirements to service it in a certain way. But like beyond those contractual requirements, I'm not really going to have an incentive to like dial up the collections activity and make sure that like the payment happens. I care more probably about maintaining that relationship and like, not like, pissing off the borrower or anything like that. And so there is more room for different incentives to creep in. And yet at the end of the day, I think the way that this can work best is if there's some mechanism to still align incentives around a set of common outcomes. What do you see there from your perspective?
So the way I think about this, let's just build on that example. So if Beyond went to a particular $30 billion institution and there was a second look that was sitting behind it, and let's say I was the borrower, also Beyond was the borrower here. So if Beyond is not happy with certain element, like there was a fee charged or what have you, my brand is associated with that, right? Because he's going to come to me and say, I'm not liking what you're doing. Everything else is behind me. He doesn't see it. He doesn't care, right? So I think from first principles perspective, I think about it this way. There is your brand, the FI's brand is associated, and Beyond's NPS is measuring me. So if something was to go wrong, I've got to handle it. So how do I do it? So there, I believe, I kind of think about the concept as there's a decisioning, governance, and logic ownership, and then there's an execution logic ownership, right? So in that example, just building on it, if there was a servicing that was happening, and since it was a second look, I'm not doing it, the loan's already been sold to a funder for the downstream, etc. I got to make sure that certain elements, core principles of collection, if you look at it from a perspective of, let's say, third-party collector or a first-party collector. As for a third party, you got FDCPA and Reg F. From a first-party perspective, you got UDAP and you got FTC. Then, the entire life cycle has Reg B with ECOA and, these acronyms, but you know what I'm talking about. So these principles, even though I am not on the hook for that loan from a credit risk perspective, since my brand is associated with that, I got to have a view on the decisioning logic. Now, in this example, it's customer management or customer/member delinquency management in that area. I have certain protocols and processes that I'm going to follow, and I'm going to enforce that downstream, because if something goes wrong and Beyond's not happy, I'm on the hook. So you got to almost break out that concept of essentially what is decisioning logic ownership across the life cycle, where this acquisition is pre-approval or it's further down into customer management, versus execution ownership. And execution ownership has to work in concert with the decision logic ownership. And if you build that dynamic through the data sharing as well as the contractual relationships, then there's going to be less and less of unhappy Beyonds in the world, right? So that's kind of the thought process I have here.
I think that makes a ton of sense. It's interesting to sort of break it apart into like the different risks that sort of exist, right? And like, credit risk is always the one that we sort of obsess over. I think in some ways you could kind of bundle fraud risk into credit risk because they're all just losses at the end of the day. But like that risk is very important. That risk is the thing that is easy to transfer, right? Like I am transferring this risk from the place where I acquired the borrower to the place that originated the borrower to the place that sold the loan and who bought it. Like the risk can transfer very easily behind the scenes and can be managed, I think, contractually to a degree. Do you make a great point though? Like reputation risk doesn't transfer easily, right? And that's something that hadn't really occurred to me until you were describing that. But it's like, even in models where the old model for second look financing was one where it was more explicit, like I can't approve you, but let me refer you to this other provider. But even in that scenario where you're introducing a third party, you're still the company that introduced me to that third party. Like the reputation risk doesn't just like leave you because of that. And so the idea of a governance framework that can account for like credit and fraud risk, which are more like material financial risks, but also this sort of execution, reputation, NPS type risk is really fascinating to me. I mean, Bjorn, I know you guys think a lot about this in terms of like the impact of payment protection insurance or other things that you offer. And, one thing I'm fascinated by is like, I don't know. Sometimes lenders can get a little too cute with like, we have to, optimize every last basis point in our entire like workflow. Like we couldn't possibly have this cost because if we do, it throws off our margin or whatever. But sometimes I think they don't account for some of these other risks that are a little harder to put into like dollars, but are real costs, right? And I feel like that comes up a lot with payment protection insurance and some of the stuff where it's like, yes, there is a cost to it, but what is the cost of like customers having a bad experience working with you because something bad that was out of their control happened in their life, and then it created a bunch of downstream risks for you? Bjorn, what's your perspective on that?
Yeah, I think it goes back to some extent to what we said earlier, and I think Aditya hit the nail on the head there with the reputation risk. So the first assumption is that if you have payment protection products in place, that assumption is the insurer will actually cover the particular incident, because otherwise you run into the same problem that Aditya was outlining of, well, I have this, but it's not providing me a benefit. And in the first instance, the reputation is at risk, not by the insurance in the background, but by whoever is there in the front end, right? Having either sold that insurance, helped sell that insurance, or provided as an additional benefit, whatever they're doing in that space. And in a lot of the conversations that I have with financial institutions, there are a lot of conversations around, are you willing to invest now to reduce delinquencies down the road? Are you willing to invest now in something that keeps your customers happier? And in a lot of cases, it is no, but I will once it happens to me. And we discussed this, earlier on a different call. It's that entire mindset of I don't need insurance until I need insurance, and then it's too late to get it. And in a lot of cases, I see the same thing. You have to have people that have that mindset of how do I calculate the ROI on something that I have to pay for today, but I might need in the future? How quickly does that ROI have to pay back so that it makes sense to do it?
Well, and I think like a notion we're sort of tiptoeing around, but that kind of ties these things together is this idea of like ownership in a sense, right? And, Aditya, it's interesting going back to what you were saying. Like one of the challenges with having this very highly modularized sort of ecosystem is that it kind of lends itself to the idea that it's like, oh, that's not my problem. You know what I mean? Like in an old world, if it was completely vertically integrated, or to your point, if you're working for a sufficiently large bank where they're still very highly vertically integrated, no one really says that's not my problem because like by definition, structurally, it is your problem. Yeah, like you own that problem. Whereas I think in a more modular ecosystem, it's easier to slip into the mindset of, oh, well, that's not my problem. Like we handed that off. That's someone else. Like I'm not going to do that. And to Bjorn's point, I think that does affect like willingness to invest in some of these things that don't have like a clear ROI. I imagine like the technology to sort of better facilitate decision governance sometimes probably falls into that where it's like, do we really need this? Like, is this like, I don't know how far we want to go in investing in this. But the other element, the other risk that we haven't really talked about yet is compliance risk. And you rattled off, Aditya, like a ton of acronyms that we cover a lot on the Fintech Takes podcast. And, to me, one of the things that's helpful, I guess, about compliance, no one ever thinks anything relating to compliance is helpful. Like it's just a burden for all of us. But like one of the things I kind of like about it just in the abstract is compliance doesn't really accept the whole like that's not my problem statement. Like compliance really focuses on accountability. And if there's an outcome downstream that's in violation of the law or that happens to customers, regulators want to sort of reconstruct what happened, why it happened, what all the steps were in the chain that led to that thing happening. And they have very little tolerance in my experience for, oh, well, you see, contractually, this is where our responsibility stopped, and now someone else is doing. Like they don't want to hear that, and that oftentimes doesn't save you. With in hindsight, when you're dealing with these problems and trying to clean them up, talk about kind of the compliance risk side of this and how it fits into good governance.
What is best? I'll answer the question like this: and I'll rephrase it in the way that what is best in class governance for decision in a regulated space looks like. I think about GRC or governance risk and compliance. I see GRC being bolted in a more, and we talked about this a bit earlier, in a continuous model. Let's take an example. And again, I like to speak with examples. Let's take an example. Let's take an example of a forbearance flag, which is available beyond, again, my dear friend. So there's a forbearance flag that has been set up and I'm originating, let's say a term loan product. The best-in-class governance would say that there is a permissible purpose for forbearance flag. It can be used for customer management, but it cannot be used for acquisition, even if that data is available at the point of decisioning, right? So you think about when the decision is being built, and as we know, in a sophisticated world of tier ones and fintechs, which are aggressively pushing the limit, your decisions can be fairly complicated in terms of so it's like a compounding problem, right? You've got underlying raw trade lines, you're creating features from them. Features are driving models, features are also driving your credit strategies, your knockoffs, your pricing, your product selection strategy, and your eligibility criteria, right? So when you have compounded decisions and you're operating at the credit strategy level in this example, it's very easy for things to just slip in. And guess when you find it? When somebody complains or a regulator comes in and says, well, show me, how did you make that decision and beyond? Well, I use this, this, and this. How did this data attribute come in? That was not a permissible one, right? And you, Alex, talk a lot about in your podcast about, if you think about permissioned data, right? So let's just building on the same example. Beyond originated, I originated a loan for Beyond, and he permissioned cash flow data for me. Okay, super. So I did that loan. That data cannot then be used within or in less than 6 months or ever, cannot be used to originate another product. But if I did not have the right governance in place for that, and I by mistake an analyst used that data, or it went into a decisioning technology where that same cash flow data, it was relatively fresh, and I use that data to make another decision, and guess what? I'm in permissible violation. If I don't have the structure set in place, that the system blocks it, and system blocks it when? Not at the point of production, but at the point where you're going through the governance and compliance, you're going through the fair lending, you're going through model risk management, and it gets blocked right there saying, hold on, you are not allowed to use cash flow data, even though it's highly predictive and you'll get, you'll pick up the needle in the haystack well, et cetera, but you're not allowed to use this data because you're not permission to use this for anything other than the initial loan that was originated. You need to have systems in place there. And what happens is when that governance gets backloaded, first of all, it creates a lot of tension between the analytical team and the technology teams, because they're trying to get that stuff into production quickly. I need to get that 3 days earlier, not now, right? So there is pressure to move that into production, and then that backloaded governance implies that the risk function is in pressure, so sometimes they can miss stuff, and et cetera, right? The decision goes into production, the regulator comes and slaps your wrist. So moving that, literally almost like a QA cycle in classical software development, you got to move that left shift, that governance further up in the life cycle, and do it at every building block. So if I'm approving the forbearance flag, I'm approving it for permissible purpose of customer/member management only, cannot be used for acquisition. Moment a smart analyst picks that one up and starts to use that for, let's say, credit decisioning for another product, it flags and says, you got a permissible purpose violation, you can't use that data. That is best-in-class governance, right? So when you build it like this, it's almost like you're systematic and you're doing the governance and compliance at the right time, not in the last, not further down in the life cycle. And when you get there, that's best-in-class. You have then less variances. You have less risk that you carry, regulatory risk that you will carry. And I think that's kind of where the puck is with tier ones, and that's where I believe tier 1.5 and mid-market should also be heading in.
This episode is brought to you by TruStage. If you're a fintech lender leaving non-interest income on the table, TruStage payment protection solutions are designed to change that. They offer compliant, scalable protection directly within the lending experience, helping improve repayment outcomes without adding operational complexity. TruStage member insurers have helped people make sound financial decisions for over 90 years, and that same thinking shapes how they build for lenders. Visit TruStage.com to learn more. Yeah, no, I think that sounds right, and it's, I guess, an interesting observation that in some ways, like, compliance risk, I think in particular, is kind of this accumulative sort of thing, right? Where it's like, it's less like acute in terms of like one big thing that happens, and more just like, if the system doesn't work well, if the governance processes aren't well designed, it all just kind of like leaks in different places, and then it just sort of accumulates over time, and suddenly you realize you have a huge problem, which is why you see even large banks that have not done this well in the past then have to remediate and make these like massive changes to their organization later on. I want to talk briefly about AI. And Aditya, Bjorn, I want you both to weigh in on this. We haven't actually brought up AI that much so far in this series, which is a remarkable accomplishment in 2026. But I do want to talk about it because, I mean, obviously, Aditya, you were saying like a lot of your background is in data science and data analytics and trying to figure out ways to like engineer decisions. We've talked about AI in lending and in financial services for a long time, but that was like lowercase AI. This is like uppercase AI. Like, it's fundamentally a different technology. And I think what's interesting about it is, from a governance perspective, it just works in a completely different way, right? I mean, it is sort of naturally probabilistic. These large language models and foundation models and agentic systems, they are also like, I know the term black box has been used a lot of times, but like, I don't know, sometimes when people say black box, it's like, okay, yes, the outside of the box is black, you can't see into it. But like the old black box machine learning models was like a well-designed gear system inside a black box that we could at least like guess how the gears worked. Whereas like the new black box is still a black box that you can't see inside, but it's like a bunch of octopuses wrestling with each other. And it's like, I have no idea what's happening in there. Like it's a completely...
A lot more stochastic in nature, right?
It totally is. Yeah. It totally is. And so, I mean, you deal with this on a very regular basis. What specific challenges does this introduce from a governance perspective? And then how do you think it affects this sort of like modular ecosystem for consumer lending that we've constructed?
Let's instantiate an answer for this with an example in customer management, right? Because where I might be, let's say I'm doing a debt restructuring, or I'm giving examples, a growth problem where, somebody comes and says, well, I have a liability relationship, and I have one auto product and I want to get a credit card product. What are my options, etc. Right? So that's more of a growth. And the earlier one was more of a risk example that I was giving, risk management example I was giving, right? So that's where, let's just say generative AI is being used there. Now, there are a couple of pieces, and I'll try not to get super deep because otherwise we won't have enough time. So at the highest level, what you have to make a determination on is when you're generating responses top down, do I have scripted responses or do I have truly generative responses? Or am I somewhere in between, right? So let's say Alex comes to me and says, I'm the issuer, and says, hey, I'm traveling. I want to make sure as part of servicing that I'm traveling to France, etc., and for this period of time. Now I can give you a very scripted response. No problem. Do this, this, and this. I got you covered. I can also be semi-generative, where within certain guardrails, I'm saying the same thing, but it doesn't come across as I'm being scripted, right? Because you might have said something about I'm visiting this city in France, etc., right? And then a fully generative response is I know your account, your balances, your activity, and I basically have the LLM create a generated response. Now, the last one carries the highest risk of variance, including PII leakage, right? In the sense that I happen to talk about beyond to you versus talking about your account. That's a big strict no. That's a regulatory fine right there, right? So you've got highly scripted to highly generative, and your risk exposure increases as I go more to the right. Okay, so that's kind of one dimension. The second dimension, you beautifully said that the whole octopus mindset is that the LLM pipelines are complex. You've got prompts, you got RAGs, you got embedding, you got a context window, then you've got input guardrails, and you got output guardrails. You got all of these things are working in concert or orchestrated together to kind of hopefully not break, but give you the outcome that you desire from your pipeline, right? So all of them, when you think about traditional AI systems or small AI systems, as you says, they could be complex, but they were relatively well constrained. You were working structured data, you knew how a GLM model works, and you could screw it up in many different ways because the degrees of variance were less. But if I got 6 or 7 different systems, and you got a frontier model, you got an embedding algorithm, and then you've got a context window you're working with, and you got input and output guardrails, there's lots of moving parts here, right? So what is important from a governance, now coming to your question, from a governance and compliance perspective, what's important here, we have actually a tool called GenGuard X, but maybe we can put in the cliff notes here. But the critical thing is you've got to make sure that your change management is done in a very rigorous way. So example, if I run a business KPI, the business wants to put the pipeline to production, and I have a certain set of KPIs, and I run it, and let's say customer satisfaction KPI is at 85%. I'm like, okay, that's not good enough. I need to get to like 94 or 95 if I'm going to move this to production. What do? I go and make changes. I change my context window because Alex was not happy with the response he got because my context window was off and the data was not correct. So that's why the LLM couldn't do a better response, blah, blah, blah. I go fix a bunch of this stuff. Now I got to run a regression suite on this again. So I'm going from 85 to 92. Super. Change management. I got to document that stuff. Then I go from 92. So think about version 1, version 1.1, 1.2, 1.3. I'm slowly making my way past that 95% KPI that I'd set for production. I get there, right? I have to make sure that as I'm working through this, almost like a design of experiment mindset, I'm changing this, then I'm changing that, then I'm changing that, then I'm changing 2 other things, and I finally got to 95. I got to know exactly the sequence I went by to get there. Because the regulators will want to know if they find a problem with that. They want to know that you had systems in place, regression suites that are running at every iteration till you got to the 97%. Now, one last part to answer to that question. This is the business side. On the risk side, I'm looking for horizontal pieces. What do I mean by that? I'm looking for PII leakage. I don't care what pipeline as a CRO or a second line function. I'm saying you got to make sure there's no PII leakage. Toxicity. I want to make sure there's no, if I have a toxic data set that I'm pumping through as a test data set I'm pumping through, it's got to meet a certain standard that the LLM does not break. Third one is something like prompt injection, right? So these are horizontal, I'm giving 3 examples, but these are horizontal tests that the risk function will want to make sure that it does not do what it is not supposed to do. The business guys care about it, does what it's supposed to do, and does it at a threshold of 97%. The risk guys are saying it does not do what it's not supposed to do, and I need to have that trust. So having that trust in AI, in Gen AI or LLM is so critical as you're moving to production. There was a recent MIT study which said only 5% of use cases go to production, right? And the market's moved on that information, right? This is it. This is the problem. The problem is the risk function is not comfortable and the business guy is a little bit cold. I know I'm being a little bit controversial, but a little bit cold feet. So like, let's scale it down, just run it for a small pilot and get down with it, right? So the complexity of governance and compliance is a lot more multivariate relative to traditional AI is basically what I'm saying, right? And then you need systems to kind of do that kind of the iterations and transparency and automation. And remember, the business people are the most busiest people here. So you can't have them come and run regression tests every time for you. They don't have time to waste. The model developers have to find ways to capture knowledge once, create regression suites and run it again and again, and then kind of do a final testing. And then otherwise you will not have any momentum. You'll not be able to get anything of value to production. So those are the dynamics of how capital AI is different than it's kind of small AI from a governance and compliance perspective. Okay.
That makes sense. And then,
I know I said a whole bunch of stuff. I hope I was not too much there.
No. I'm glad you went into that detail because, I mean, you live in this world and clearly like deal with these exact concerns on a daily basis. Bjorn, the flip side to everything Aditya just described on the institution side, which I also think is relevant to our sort of core thesis for this series, is it does seem like AI is going to also sort of potentially act as, I would say, a bit of a sort of connective tissue or translation layer for the customer across all of this stuff, right? Like a thing we've talked about in previous episodes is, you know, like what does a customer do when they have a problem and they don't know who to direct that problem to because their experience was just laundered through 4 different stakeholders at different stages. And it's kind of reminds me of like, I don't know who my mortgage servicer is because it keeps getting resold. And who do I send my check to? I don't know. Feels like AI on a customer basis has the ability to maybe smooth some of that stuff out over time or make kind of like a consistent interaction layer for the customer that abstracts some of these complexities or confusing parts away. What do you think about that side of it?
I would agree with that. The challenge that has to be solved is how do you make sure the data is actually fed into wherever the consumer goes and asks a question of, let's assume, right, I go to my bank, whatever, mobile app or my bank's website, and I ask them a question around who's servicing this loan. If the bank doesn't know, I'm going to be just as frustrated with the AI answer as I was before, maybe even more frustrated because I'm expecting them to know. And so if we have this fragmentation of all these different service providers and everyone has their own AI solution from a generative, talk like chatbot type thing. If they don't know each other's answers or the data or what has happened in the background, it can get even more frustrating. Now, I might get an answer of, oh, it's not with me anymore. You dropped this in January and it looks like blah, blah, blah. Maybe go to them, right? So there could be some indicative answers coming out. But in a lot of cases, for me, that's the frustrating piece is I go in with enthusiasm and I'm hoping, hey, this is going to be so much easier. I can actually go and just ask a question. And then this gibberish comes back because it doesn't have the data to actually answer my question for me specifically in some sort of intelligent form.
Yeah, I mean that's the concern ultimately, right? Is that like this has to, and it kind of goes back to the discussion on the governance side as well. Like the connective tissue, the plumbing has to work well enough to enable these types of experiences or these types of outcomes. Aditya, I want to wrap up by asking one final question, which is, if you could fix or change one thing about how lenders build and govern their decisioning processes right now in 2026, what would that thing be?
I'm going to give you a bonus. I'm going to give you two, okay?
Please do, yeah.
if that's okay.
Of course.
We already talked about the integrating governance in the build cycle, so I'm going to leave that aside. The two are, in my mind, one, this is a subtle, but it's a very first principles point, which if you really ingrain it, it has big benefit. Keep your analytical systems separate than your production systems, okay? So when you're doing decisioning and you're doing governance, you're doing experimentation and iterations, whether it's AI or capital AI or small AI, it doesn't matter. Keep your analytical systems separate than your production system. What happens is when you're not fully aware of everything in the mid-market, there is sometimes a tendency to say, well, I can run my reports in my LOS as an example. But that is not a good idea. It was one thing, and again, without getting too much into the rabbit hole, the LOS is not capturing your loan performance data. So when you're looking at reports on your LOS, guess what? You're looking mostly acquisition reports at the point of acquisition, right? But if you want to adjust your credit strategies, you need to look at your loan performance data, backtest, and all of that. That core banking data is not coming into your LOS. So you do get some nice, pretty reports, sure, but it's not the right environment to do it. You need to have an analytical environment where you can pull in your application data, your loan at the point of origination data, including the bureau and the bureau data that you had used for decisioning, and then you need to get your performance data in, and you need to be able to look at not just mature performance, but even like first payment defaults and things of that nature, right? 30 days default on the first payment, then second DPD. You can get pretty sophisticated, and you need to keep your analytical environment separate if you have a desire to scale up your business, right? So that's one thing I would fix, because I don't think it's tier ones don't have to worry about this because they're ingrained in this. The analytical environments of decisioning are separate. They don't need to be told it's preaching to the choir. But the next level down, that might not be so obvious. So that's one thing. The second one I would say is really, and we talked about this a bit earlier, is really thinking about governance across the life cycle of the customer/member, right? Don't think about it only at acquisition. Don't think about it only in servicing. And most important, don't have silos. Have intermesh. And you talked about that connective glue of governance. I think that's a very important point. It sounds like, it sounds cliche, but when you actually start to implement that, the whole virtuous cycle of governance kind of flowing back in, and compliance and governance working in harmony, right from pre-approvals right up to delinquency management and the life cycle forming a closed loop, that is super critical. So don't think about governance in silo. Think about it across the customer life cycles. Those are the two.
Awesome. I heartily agree with both of those. Yeah, Bjorn, last word for you.
I was just going to add to what Aditya said is I think you could summarize that as very high level. Don't think in silos. It doesn't matter if you think about silos on the data side, because then you're not capable of doing full-on analytics across different areas. And don't think about silos on the governance side, because that also doesn't work. So while we are all talking about more and more different applications being in this system of end-to-end lending and, quite frankly, across all financial institutions, we have to think, yes, they are quote-unquote silos applications, but we have to think about how do we make sure they don't stay siloed from a data perspective, from a governance perspective, from all the other different perspectives. And I think that's one of the biggest challenges.
Yeah, I absolutely agree. I think that's very well said. Aditya, we're going to let you go now. Thank you so much for coming on the podcast. Really a joy to have you. And Bjorn, thank you as always for being my co-host. This was a lot of fun.
Thank you.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.